Shut up and sit down.
Good afternoon, everybody. Welcome back. This is episode 30 of the Rebel Trading Podcast. What is going on? As always, the gluten-free Jason Bessing here. Unfortunately, my co-host Nathan unable to be with us. I think he got caught up at work, but it's okay. The guy grinds it out. He works hard. I have a crappy schedule, and his is even harder, so I feel for him, so I'm just going to take the reins. We're going to let him do what he needs to do and get him taken care of, and he's going to be back with us next week. But I'm going to pilot this airplane today. It was a very interesting day. I'm doing this right at 4 o'clock, right at the bell, because I just wanted to be talking when results came out. So, like I said, it's episode 30. Let me hit you with the date. It is Thursday, July 26th, 2018. Let's go ahead and pop over to the numbers. Dow up 112 points. NASDAQ down 79. S&P down 8. We're going to talk about this. It was a mixed day. So we're going to loop right back to that in just a second. But just to wrap it up, we have cryptocurrencies. Let's pop over to Bitcoin, trading at 8,257. That is up $800 from last week, people. And I think when we first started talking about Bitcoin more often, more frequently in the show, maybe around episode 24, 23, we were looking at $6,300. It was bad. And we're up almost like 30% from that? 20% from that? In a month? 35%. But whatever, I guess Bitcoin is reckless, whatever. But yeah, so kind of a mixed market today. That's going to go ahead and reflect right into our news. Facebook. That's the headline du jour. Facebook missing on earnings just a little bit, but the daily active user count plummeted and is going down and keeps continuing to go down. And investors panicked today, and Facebook, I'm going to give you the exact number, closed down 18.8%. That's a $41 loss in a single trading session. It was her worst day in history. IPO'd in 2012 after her prime. She should have IPO'd during that tech bubble, but whatever. Excuse me. So, yes, Facebook losing $41 in a single trading session. There was a report out earlier, right at the opening bell, that Zuckerberg went ahead and lost $120 billion in market cap for Facebook. $120 billion. That's more money than you can imagine. It really is. Like, you couldn't spend that in a day if you tried. Like, that's so much money, and it's just vanished out in thin air because investors panicked. I do not think it is a buy. I still think that it is very overvalued. Let's see. The PE is still 30. We're going to talk about that today. That's actually our topic. That's our market terminology today, is the PE ratio. But that is something that I wanted to address. It's a major market mover, and that is why the NASDAQ and the S&P sank today. But guess what? Facebook's not in the Dow Jones average. And the Dow had a beautiful day. I don't know about a beautiful day, 100 points, but the Dow had a day, for sure, compared to tech stocks, and it's all because of Facebook. Facebook is heavy enough. It's like somewhere in the ballpark of like 3% or 3 or 4% of the movement of the S&P alone. Something like that, 2, 3, 4%. Ridiculous. So, of course, the entire indexes are going to come down with it. But luckily, my Dow fucking Jones holds strong because she's not susceptible to bullshit like Facebook and her overvalue and overpriced stocks. It's ridiculous. 30 times PE. That's after coming down. So what was it before that? Like 48? That's ridiculous. But I'm going to play devil's advocate here because while I have been talking, Amazon has released earnings. She expected $2.50 coming in, crushing it. at $5.07. I'm going to pull up the exact numbers. I'm going to see what she's doing after hours real quick. Amazon making all kinds of weird moves after hours. I can't get an accurate description. After hours is very volatile in general, but she did have a quick, looks about to be a 4% pop. Looks to be about a $78, $80 gain in the after hours session. But then she plummeted really quickly. But we're going to get a more accurate picture of what happens tomorrow. So it'll be interesting. She came in, what's that, 100% above expectations. They doubled the expectation. That's pretty good. That brings us back to my previous point, though. These ridiculous high-flying companies with these ridiculous multiples, they will climb, absolutely, because of the hype. It's not because of the valuations of the company. It's the hype, the speculation of the future potential of the company. For example, like I said, let's go ahead and use Facebook. They went and they earn, looks like roughly $6 a share each year. That is their estimates. Okay? But the stock was trading at $220. That being said, that multiple is what? It's like a 50 PE, 45 PE. So that means that you're paying $45 for every dollar it generates. Amazon is much worse with a PE of $293. You're paying $293 for every dollar that Amazon is returning. It's not a good return on capital. However, the stock does go up. It absolutely does. It will continue to go up as it continues to do well. But the second that it doesn't, it's going to come down hard like Facebook. It's going to come hard on your face. Just look at it. Facebook plummeted 20% in a single day. People got murdered. And I'm going to be honest with you, it was probably all retail investors panicking, selling off, and Wall Street just laughed on the way down. We also had, I'm going to keep the ball rolling here. I'm not going to linger too much on this because I know I like to hear myself talk sometimes. Now that Nathan's not here to stop me, I'm just going to keep going and going and going. Starbucks came in. They beat earnings at 62 cents. We're not going to look at them. Intel came in, beat earnings by 8 cents. Yeah, just an interesting day. Very interesting day. Big earnings week. Most of it is going to be the tech week, the NASDAQ week for sure. So, go ahead and move forward. News continues to be taxes, tariffs. Another big market mover was Ford. She's now trading below $10 a share. You know how I feel about her. She closed at $9.88. Ugh. Just ugh. Down another 6%. And it all comes back down to tariffs, trade talk. Dividend yield is over 5.5%, and they have the cash on hand to maintain that dividend through a very, very rough time for a very long time. It's a very well-run company. Give it some time, sit on it, believe, be a believer. So that's kind of it for news. It's just the earnings week. You know, this is one of the biggest weeks in earnings, and that's pretty much it. Let's go ahead and move over to market terminology for today. We already discussed it a little bit. I kind of got into that, got into it a little bit in my rant. I'm talking the PE ratio. And what is a PE ratio? Well, it's a very important, what I call Jason Bessing Instametric, the gluten-free Instametrics. It's one of those things that are first there every time you pull it up on your broker's site. It always shows you what the PE. And what the PE means, it's the price to earnings. Oh, wow, that sounds really confusing, complicated, like you're going to have to do some math. Not at all. I'm going to give you a very easy example. Let's say you have a $10 stock, and every year they have an earnings of $1. 1 divided by 10 is 10%. So the earnings multiple is 10. So what this actually means, when you look at that number, and your broker will display it right there for you, what that means is every dollar you're spending and how much you're going to get back for it. So if the PE multiple is 10, that means that you are paying $10 for every dollar that the company is getting back. If the PE multiple is 100, you are giving the company you're paying $100 for a company that generates $1 on that. You have to think of it from the business perspective. And obviously you want a very low PE, right? Well, yeah. The average is between 15 and 18 on the S&P. That's the average PE, or price to earnings, also called the multiple. Some people just call it, what's the multiple on that? So the lower the PE, obviously, the more value. However, this isn't always true. In theory, it sounds like it works, but it's not exactly the case. There are some companies that generally just have small PEs. And Ford, going right back to it, is a perfect example of that. I'm looking at it right now. It's 5.7. It's almost a 6 PE. So every $6, you're getting $1 back. But the problem with Ford is that the stock doesn't really grow. So you're not going to get return on that. You're not going to see that return in the company. You're going to see it through the dividend. So a lot of dividend-paying stocks have very low PEs, and those are your value stocks. REITs, however, tend to have generally high PEs, and PEs aren't really what is looked at when you are looking in the real estate market, because the PE will vary anywhere between 10 and 200. More important fact when you're looking at a REITs is its cash flow, or its funds from operation. I'll save that for a different podcast, but my point is that you want to look at the PE differently with different stocks. But a good general rule of thumb is a lower PE is a better return on your money. You never want to use one indicator or one ratio to determine if a stock is a good value. You want to use a multiple of them. You want to use all of them together to give you the bigger picture. But a low PE is one of those things in my brain that when I see it, it instantly clicks for me to see, okay, I'm going to dig further now because I like the PE. It's right there. It's one of the first things I look at. I look at the market cap, and I look at the PE, and I look at the dividend yield. Those are like the first three things I look at to see if I want to go into the company anymore. So that is your price to earnings ratio. And yeah, it's a very important, very basic metric, and a very easy way to tell if a stock has value. So, price to earnings, also called the multiple, is literally your return per dollar. If a PE is 5, you're giving $5 and you're generating $1 on that. So if you have any questions, comments, concerns, suggestions, insults, or corrections, please contact me at rebeltradinggroup@gmail.com. That's Rebel Trading Group with 2 G's at gmail.com. All right. Let's move to the topic du jour, shall we? Today, I kind of want to gloss over a thing called diversification. And this will be more for the investors, or the set it and forget it investors out there. Diversification is very key to portfolio growth. It's one of the very fundamental things of portfolio theory. It's one of the first things you learn about is diversification. And obviously, it's kind of for obvious reasons. Sometimes, if you put all your money in one basket, it can do one of two things. It can either go to the moon and make you all the money and make you very rich very fast because you put your bet on one thing and it worked out, or what will probably happen, you will lose all of it, or lose most of it, or not make a lot on it. So if you diversify, it gives you the chance to have money in different pots, right? And it's a great way to kind of stretch your dollars across the U.S. economy. And that's what you really want to do, because some sectors will boom. The past few years, oil has gone up. It's done really well. Everything's actually done well stock-wise, but just everything. Technology has done phenomenal. Utilities didn't do very well. It went up, but not nearly to the extent. Gold has kind of been bleh. But if you have money in all of that, yeah, you're going to catch a little downside, but then you're going to have some money for the upside. And you don't have to worry about one company destroying your portfolio because they missed earnings or they're cutting 30,000 employees or something like that. So diversification can be achieved by buying several different stocks. I think you can diversify with 10 stocks or more. Or you can do it through the use of funds. Funds are a very easy, probably the simplest way to just go ahead and diversify, because funds hold many companies. You can choose funds based on sectors. So say you want exposure to technology, you're into technology stocks, so you want to put money towards that. Well, you can look at a fund like, let's say, XLK. That is the S&P technology sector. That gives you exposure to Netflix, Amazon, Google, Apple. I'm sorry, not Amazon. Amazon is not in that. Netflix, Google, Apple, NVIDIA, Intel, IBM, Microsoft. We'll give you exposure to all of those just by owning a single share. So some people want to have like 30 different ETFs, and I think that's a very dumb thing to do because you're going to overlap. But you can diversify simply through buying separate stocks or choosing an ETF. ETF is definitely the easiest way to go. If you want to be a set it and forget it person, it's definitely the easy way to go. Or you might want to diversify across 10 stocks, have a little bit in technology and kind of back that up with something a little bit safer. Maybe you have some money in utilities, like a dividend payer, something that'll do good in a recession, like consumer staples or grocery stocks. Something that pays a dividend through a recession, have the economy just take a plummet for the worse tomorrow. At least your portfolio is spread across to protect that. Caveat to that, though, if you don't want to diversify, I say you are a rebel and you fucking go for it, because there are chances that things may just work out in your favor. For example, if you have money spread across 30 stocks, you're going to have some winners, some losers, but for the most part, your stocks are going to go up and you're going to make your average 8 to 12% a year. Or if you put everything into a single fund or a single stock, and you say, hey, this stock pays dividends, I'm going to pour money into Coca Cola for as many years as possible because it pays dividends, and every time it pays a dividend, I'm going to buy more of the shares, and I'm just going to keep going because I know Coca Cola will be there tomorrow. Well, go for it. Do that. If your plan goes correctly and you have full faith that Coca Cola is going to be there when you approach retirement age, and you are willing to buy if the stock is down 50% or up 200%, you are willing to buy and stick to the plan, you can stay disciplined, it will probably work out in your favor. You will probably retire rich. And that's true of many dividend-paying companies. And a lot of people do that work for the companies. A lot of people will purposefully put that in their 401k because they get employee stock options and they go really heavy in the company that they work for. A lot of union companies like airlines and automotives, they're big components of that. Proponents of that. Proponents? Component? They do that. That's a thing that they do. So you could do that. I've considered doing that with just S&P funds, just dividend reinvest the S&P or the NASDAQ or the Dow Jones. Get that instant diversification, but at the same time, you load up on one single thing. And you buy as many shares and you put those dividends right back in and you load up and you compound, and before you know it, you have 22,000 shares of the S&P 500 and you're ready to retire. So diversification, definitely important. You can do it in many different ways. You can have bonds here. You can put utilities here. Then you can put technology. I know there's like the two examples I keep using. Man, there's other sectors. You can have some industrials because you don't know anything about Caterpillar. You don't know anything about building a house, but you know that sector is doing well because the economy is going up. So you buy a fund of that, and that takes up maybe 5-6% of your portfolio. And you spread it across, and you just let the market do its thing. You chop some of the losers. You maybe kind of put some money into the winners, or vice versa. You cut some of the winners and kind of buy some more of the losers that you have faith in. it's really on your choice. A lot of this game is tuning everything to how you want to do it, tuning everything to the way you like it and what you feel comfortable with. Diversification, spread that money out there. I diversify. I like to hold about 30 stocks, but my general rule, I consider one ETF, I call that 10 stocks. So if I have 3 ETFs, that's my portfolio at that time. Or I might have 2 ETFs and 10 stocks. Because I don't want to overlap. That's kind of the opposite of diversification, would be like overlap. And that'd be someone who, like, for example, would say owns Apple, owns a lot of Apple, owns a lot of Tesla, and owns a lot of Boeing. And then they also own a lot of the S&P 500. Well, you own Apple and you have exposure to those things within the S&P 500. So why don't you just do one or the other? Because if Apple goes down, then your whole portfolio is just going to shit because everything's in Apple, or everything is reflected in those 3 powerful stocks, those market-moving stocks. So it really depends how you want to do it. But if you want to be the hardcore balls-to-the-wall dividend reinvestor of a single multinational conglomerate, then fucking go for it. I mean, if you have the balls to do it and you are able to watch the years of pain go by and able to have the discipline to sit through the good years and not pull money out from it, then anti-diversification, or not diversifying at all, it may be one of the best things you can do. May be the best strategy for you. So it really depends on you as the investor. Play the game how you like to play it. So I'm going to wrap it up today. It was it's just a nice day. I felt like talking a little bit. I miss Nathan, but I just wanted to get an episode out. I want to keep my baby alive. Real quick, I am watching a company. I don't know if I've used it before. One of my favorites. It's Yum China Holdings. It's the company that owns KFC, Taco Bell, and Pizza Hut, and they are solely in China. One of the reasons I like it is because fast food is kind of a new concept over in China. It's not something that they've had forever like we have as Americans. It's a growing concept, and it's something that is on the rise, as well as China's middle class. So I like that. They actually do very well in the KFC parts of the company. The Pizza Hut, Taco Bell, not so much. That's where they're struggling. And that's why the stock took a dip a while ago. It dropped about 11-12% over the course of 3 months or so. It took a nice dip. And yesterday, funny story, I actually decided to buy a little bit of it, put a little bit in that pot just because I knew it was on a discount. And today at the opening bell, for the first few minutes, we shot up a whole whopping 22% in a single trading session. We went all the way to $41. And we came all the way back down. We closed at 35, which is still up 10% for the day. So had a great day, but personally, I still see a lot more upside. We saw that she can charge up real fast today. So it's something that I plan on holding for a while. I probably don't own anything longer than like a month for the most part, but I have belief in China. I think if you're willing to sit through the volatility, China continues to be a place of high value, more so than the U.S. markets. But you've got to sit through the TTT, the Trump tweets and tariffs. You got to sit through that and just keep sticking to it. But I think China will be the best place to park your money for a while as far as growth goes. So this is one of my favorite companies. They also have zero debt. At least that's the last time I checked, maybe 6 months ago. I'm pretty sure it's the same way. It's a very smart move. If you're trying to expand in a foreign country and you don't have any debt, that's going to be one of your best qualities. Because you're not going to take on debt to try something in a foreign country. And I don't know. I like that. I'm comfortable with that. Zero debt, Yum China. I like it. Room to grow. Let's do the damn thing. So anyway, that's it for today. I wanted to just kind of get something out to you guys. Excuse me. I'm exhausted. I hope you guys enjoyed the episode. If you have any questions, comments, concerns, suggestions, insults, or corrections, please email me at rebeltradinggroup@gmail.com. That's rebeltradinggroup with 2 G's at gmail.com. We are on SoundCloud. We are on YouTube. If you like our newest 4 episodes, will always be on SoundCloud. If you like a full archive of all of our episodes, that will always be free to you. Our favorite person, always forever, on YouTube. So check us out, give us a like, subscribe, share us with your friends. I hope you learned something, and we would really like you guys' feedback. Shoot us a message, comment. If you hate us, let me know about it. I would love that. So, I love you guys. Thanks for listening. Thanks for putting up with me. It'll be better next week when Nathan joins us. But until then, happy trading and go kill it.